Hello, everyone. Welcome to Money Hour Radio, a show where we try to help you grow your money, pay less taxes, have a beautiful retirement. I am one of your co-hosts, Ben Barzideh. As usual, I have my esteemed, intelligent, funny co-host, Matt Nadeau, here with me.
Hey, everybody.
We are both founding partners and wealth managers at Barzideh and Nadeau Wealth Management, a comprehensive financial planning firm located locally right here in Barrington and serving the greater Chicagoland area. We are fiduciaries, and as an independent, family-owned firm, we truly have the freedom to focus solely on your interests, not some corporations or those shady private equity companies that are buying everything up these days.
Oh, and of course, as always, we want to take a moment, say hi to our clients. You tell us you listen every week. We really thank you for that. And of course, we appreciate the trust you place in us, and we love every one of you. We have a great show. I know we say it every week, but I think it's an excellent show this week. So let's talk about a few different topics. In this segment, we are going to focus specifically about tech this week, and tech's falling. We're going to talk about why, some of the things we're seeing within the tech industry specifically, and what may be causing that, what we're watching for. And then we're going to dive in and we're going to actually take a focus on our advance and protect investment philosophy. And the focus today, I really want to talk about how it helps us avoid emotional reactions to volatility. So it kind of goes hand in hand with what we're seeing. And then later in the show, Ben had a really good appointment earlier with somebody. It brought up some information about inherited IRAs. So we want to tie all that in and talk specifically about how to navigate the different rules with inherited IRAs. So you don't want to miss any of that.
It's going to be such a good show. Before we start, we just want to give a heads up. So we have our annual fun party, our BN Wealth Client Appreciation Gala coming up. It's Friday, August 14th. It's going to be a night of celebrations, dinner, dancing. We have entertainment by the Blue Water Kings. They're nationally acclaimed. And guess what? You have time to become a client and come. So if you've been on the fence, if you've been looking at contacting us, potentially looking to become a client, what great motivation. You can basically become a client and come right to the event. It's, you know what it's like, Matt? It's like cutting in line all of a sudden at you're at Disney World and you get to just cut in front of the line.
Yeah.
Even though you don't.
What a great analogy.
But yeah, we would love to see you there, become a client. It's going to be a lot of fun. All right, let's get into our first topic today.
Yeah. So, I think the question we're going to be talking about this week is what's going on with tech lately. It's definitely been another bad week, and that's what some of you out there are probably thinking. We've had a few people ask us about it, and quite frankly, it's like the broken record or the boy who cried wolf. It's the same issues that we've brought up multiple times, and many of the same concerns. And the concerns really boil down to one: hyperscalers, and the focus with them is they're spending maybe too much money on an AI build out, and if you're spending all that money, number two, the issue is AI investments not producing positive return on investment. So when we say hyperscalers and we say CapEx, capital expenditures, what we're talking about is how much these gigantic tech companies, Google, Microsoft, Meta, Oracle, what are they doing when they're spending on all of these data centers, the construction, all of the infrastructure around AI?
That's right. The data centers that may be coming to your neighborhood soon. They've become polarizing recently. All right. So first, the amount of money being poured at limited AI components has caused the prices of previous, what we call commoditized tech parts, such as semiconductors or memory, it's caused them to skyrocket. And costs related to AI data center build out and AI infrastructure has substantially reduced the free cash flow of these large tech companies. Now, Meta and Oracle are some of the worst cases. But most major hyperscalers have seen annual cash flow be substantially reduced, and some even going negative. And investors are hoping that this was kind of a temporary phenomenon, but it's now lasting so long that it's caused a second concern for investors. These companies are having to raise money to keep up with the AI infrastructure race.
Yeah, so these hyperscalers, they're really caught in like a bit of an echo chamber. It's spending increases by one, then it elicits this, oh no, we're behind response from the others. So they're almost like competing with each other to actually outspend and secure additional capacity. So companies that had no need to raise capital are now coming to market aggressively to issue debt, more equity, and over the past few months, Oracle, Google, Meta, and others have raised a bunch of capital as free cash flow can't actually keep up with all this intense AI data center spending wars. So, case in point, just this week was earnings. We're going through it now. So, we had Tesla, we had Google, and this concern is what caused their stocks to fall big on Thursday.
Now, other concerns this week revolved around macroeconomic issues like rising oil prices and inflation concerns. So the 10-year yield on the 10-year bond touched 4.71% early Thursday, eclipsing an intraday peak of 4.69% from mid-May. And now it's actually the highest level since January of 2025. So that's pressuring things. And because of that, odds of rate hikes by the Fed, they have now increased. So Fed funds futures are pricing in almost a 36% chance that the Fed will raise rates next week when they meet. That's up from a 12% chance only a week ago. Now, odds of a rate hike after that in September 16th meeting, that has also increased to 81% now.
Yeah, that's crazy. I mean, that is a lot of expectation for rate hikes, especially when we had such good inflation numbers recently. So we'll
No
see
doubt.
about that. Yeah. Well, let's switch topics and really focus, like, again, about our investment process and how it helps us avoid emotional reactions to volatility and different things in the market. So, as you start thinking about these concerns, it is understandable why many investors feel the urge to react whenever markets become more volatile. So, here at BN Wealth, these are exactly the kind of situations that inspired us to develop our advance and protect investment philosophy. And one of its core principles is not all volatility is created equal. Some market declines are just normal fluctuations. And that occurs even during the most healthy bull markets, right? We know it's going to fluctuate. But other levels of volatility can actually signal a meaningful change, something that's actually changing the investment landscape. And the challenge is recognizing the difference.
Absolutely. That's the crux of it. So rather than reacting to every headline, we believe it's important to evaluate whether new information has actually changed what we call the weight of the evidence. Has the long-term trend deteriorated? Are economic conditions changing in a meaningful way? Or is the market simply digesting new information after a period of strong gains? So those questions help guide our thinking far more than the market's movement on any single day. And most periods of market volatility, they do not require significant portfolio changes in our view. But when the evidence suggests market conditions have changed in a meaningful way, we believe investors should be prepared to adapt rather than simply just hope conditions improve and just ride things out.
Yeah, and it's important to just let everybody, of course, realize and know no investment philosophy can eliminate uncertainty. So the difference is we actually believe in having a disciplined process that helps investors make more thoughtful decisions during these periods of market volatility. So it avoids those emotional reactions while remaining prepared to adapt if conditions truly do change. So advance and protect is a focus where we really believe investing isn't about predicting the future, right? Can't do that. But it's about following a disciplined process that helps us respond thoughtfully as evidence changes. So we utilize research with quantitative and technical analysis to really measure the dynamics of the market under the hood and be able to adapt based on those.
However, we monitor our investment positions every single day, and we can quickly react if necessary. So if market conditions do deteriorate, we will actually get defensive by selling out of the stock market and going heavier into defensive areas like into bonds, into cash, while we wait for things to improve. And depending on how bad things are, we may literally get 100% out of the market at times if we see conditions warrant it. In fact, earlier this year in March and beginning of April, there was a 3-week period where we were out of the stock market during some of the worst hits that was kind of happening during the Iran U.S. war when it started. So we always like to ask, do you have someone watching your money that closely? We feel you should. And if our investment philosophy resonates with you, then reach out to us and schedule a complimentary consultation. We'll go over your current financial situation, your goals. We'll even analyze your current investments. If we can help you, that's great. If we can't, that's okay too. We'll still part as friends. And then guess what? Perfect opportunity for you to move forward on that, because we are having our client appreciation gala coming up in a couple weeks. That's our once a year huge party we have with our clients. It's at a very fancy country club. We serve wine, dinner, music, dancing. So to explore becoming a client so you can come to that, visit us at bnwealth.com or call our office at 847-780-2980. You still have time to become a client. All right, don't go away, because when we come back, we're going to talk about navigating inherited IRA rules.
All right, welcome back. Thank you for tuning in. This is Money Hour Radio. It's a show where we try and help you grow your money, pay less taxes, and of course, have a beautiful retirement. I'm one of your hosts, Matt Nadeau. I have with me my esteemed and educated, smart, brilliant co-host, Ben Barzideh, with me today.
Hello, everyone.
And we're both founding partners, wealth managers here at Barzideh and Nadeau Wealth Management. It's a comprehensive and independent financial planning firm. We're located right here in Barrington and serving the greater Chicagoland area.
No doubt. Before we start, a couple things I want to mention. One, we encourage you to sign up for our weekly commentary, our market commentary. It's called the 5-Minute Market Brief. You can sign up for it at bnwealth.com. We talk about what's going on in the economy that week, what we're seeing in the market. In fact, we started putting that on our website going forward, but the best way to get it as soon as possible is to subscribe, because it does take a couple of days before we put it on our website. And then also, we are having our Client Appreciation Gala next month, BN Wealth Client Appreciation. It's our once a year party where we just have a great time with our clients. We rent out a country club. We have wine, dinner. There's going to be a live band, music, just a lot of fun. And you have time to become a client. So it's on Friday, August 14th. And plenty of time to reach out to us and see if it's a good fit for you to become one of our clients. And if so, you get to come to that. All right. Now, we want to talk about navigating inherited IRA rules. And what's interesting is one reason we wanted to talk about this week is I had a call a couple days ago with a son of one of our dear, dear clients. And he lives in another state in California. And we had a really nice event for our clients earlier this year, where we, again, rented out a country club, served wine and dinner, but it was a beneficiary party. And we wanted our clients to bring their beneficiaries there. And we talked about a host of important things you need to be aware of when that time comes, when one of our client passes, and then the heirs get involved and the assets transfer over. So I was kind of going over that again with them. And I thought, you know what, since it was such a good conversation I had, let's talk about it in radio today. It's been a little while since we talked about it. And then specifically inherited IRAs, because that's one of the areas where there's so many different laws and it can be very confusing. So the only person that can roll a deceased IRA into their own name is the surviving spouse. They have the most flexibility. But for other beneficiaries, like our kids, for example, or our grandkids, the best option is usually to open up what's called an inherited IRA account. But they also come with complex tax rules that beneficiaries must understand to avoid costly mistakes.
So depending on a few things, especially when the original retirement plan owner dies, some of these beneficiaries are forced to pull the money out in 10 years while taking some required minimum distributions during those first 9. And then some actually have to pull out the money by year 10, but with no RMDs through years 1 through 9. And some get to pull the money out over their entire life expectancy. And one more, there's even a beneficiary group that gets to stretch it out over their life expectancy until they reach age 21. And then at that time, they have to switch over to the 10-year rule. Ben, there's so many moving parts. It's enough to make your head explode. So we just want to try and simplify it out there the best we can.
No doubt. And laws have changed. So the end of the stretch IRA. So let me give you a story about that. So before 2020, non-spouse beneficiaries could stretch distributions from an inherited IRA over their lifetimes, allowing for extended tax deferral growth. They would just have to take a little bit out each year, maybe 2 or 3%, while they let it defer. This strategy was especially popular for passing wealth across generations. However, the Secure Act replaced this with a more rigid framework, what we call the 10-year rule. So under this rule, most non-spouse beneficiaries must fully deplete the inherited IRA within 10 years of the original account holder's death. And this change significantly compresses the tax deferral window and can lead to higher taxable income during the distribution period.
Yeah, definitely some tax planning's involved through all of this. And that's why it's so critical to understand it as well. So one of the biggest points of confusion since the Secure Act is one of these things we talked about is, do these beneficiaries who do the inherited IRAs, do they have to actually take an RMD out every year during the 10-year window? And it took a few years for the IRS to finally clarify this, and they have. So here's how that works. So we're going to start with the original account owner, the person who owned it before they passed away. If they had already begun taking RMDs before they passed away, the beneficiary must continue those annual RMDs, but it's based on their own life expectancy. Now, these RMDs need to be taken out each year, yet the account still has to be completely and fully distributed by the end of year 10. It's got to wipe it clean. Now, if the original owner who had the IRA had not yet reached RMD age, the beneficiary now has a little more flexibility. They're not forced to take money out years 1 through 9, but the account does still need to be emptied within the 10-year time frame.
And that's so important because if you just take out the minimum that you got to take out during those 10 years, oh boy, that could leave a huge withdrawal in year 10 that you got to take out. And then depending on how big that is, that IRA, it could potentially throw you into a huge tax situation where you move up in the tax brackets. So it requires careful planning. Now, there's exceptions to this 10-year rule. Not all beneficiaries are treated equally. For what they call eligible designated beneficiaries, EDB for short, they may still use the lifetime stretch method. So the method that went away, well, guess what? It didn't fully go away. So here are the people that can still use the lifetime stretch. These are surviving spouses, if they don't want to roll it over into their own, minor children of the account holder until they reach age 21. Then from there, it's the 10-year rule. Individuals who are chronically ill or disabled, and then beneficiaries not more than 10 years younger than the original account holder. So these individuals can take those required minimum distributions over their own life expectancy, preserving the long-term tax advantages of the inherited IRA.
Yeah, that one line is confusing, Ben. I know people where they hear beneficiaries not more than 10 years younger than the original account. So like the example would be, this is typically like if your beneficiary is a boyfriend, girlfriend, or like a brother or sister, a sibling. So let's say the owner passed at age 78 and their beneficiary is their brother who's age 76. So he's not more than 10 years younger than that, and he would be able to get one of these old benefits. So perfect. I know they love making it confusing. So let's talk about some strategic considerations if you're a beneficiary, because understanding the rules is essential not just for compliance, but Ben, as we've mentioned, you've got to do some smart tax planning. So there's a few tips. You've got to coordinate these withdrawals with your income. So if you take large distributions in the same year you have high income, that could push you into higher tax brackets. So you got to be careful about that. You may want to consider like Roth conversion. So let's say you inherit a traditional IRA and expect rising income. Converting portions to a Roth IRA may reduce future tax burdens. And working with a financial advisor. So nuances of RMD calculations and tax implications do make professional guidance invaluable. And I do want to just point out one thing when we were talking about Roth conversions, right? The whole concept of all of your income planning, whether it's taking withdrawals from inherited IRAs, taking withdrawals from your own IRA, doing Roth conversions, all of that creates income, and it can create sometimes massive tax problems. That's where you got to do all of this coordination.
And one other wrinkle in this as well. So this whole inherited IRA concept that we're talking about, well, generally how it works is our kids have to elect that after we die. So once we pass and they're the beneficiaries of the IRA, at that time, they elect to do this to do this inherited IRA versus just cashing it all out at once. But believe it or not, in most cases, our beneficiaries do cash it out at once. So there's ways you can force them to do this inherited IRA concept. It's called a standalone retirement account trust. We call it sometimes an inherited IRA trust, but that can be very valuable. So you definitely want to talk to an expert. And guess what? If you are in need of an expert, a knowledgeable financial planner, someone who puts your interests first, we would be honored if you give us an opportunity to speak with you. If our investment and financial planning philosophy resonates with you, then reach out to us and schedule a complimentary consultation. If you're getting nervous about what the market's doing right now, if you want a plan to help protect it in case things get worse, it's another reason to reach out to us. We'll go over your current financial situation, your goals. We can also provide a financial checkup where we analyze your investments, your taxes, your estate plan, all at once. And if things look good, you'll gain some peace of mind. If there are holes, then you know at least where you want to fix. Many people have never had someone look at all areas of their financial life all at one time. And if we can help you, that's great. If we can't, that's okay too. And then also, lastly, before we end today's episode, I want to give a couple updates. One, we have our big client appreciation gala coming up. This is for our clients. It's our once a year huge party that we have. We have dinner at a fancy country club. We have wine. We have dancing. We have music by the acclaimed Blue Water Kings. And it's going to be a lot of fun. It's Friday, August 14th. And guess what? That leaves you plenty of time to become a client between now and then. So if you've been on the fence, if you've been looking to potentially speak with us, maybe this is some motivation for you. And then also, even though you just recently became a client, in my example, you get to come. So I jokingly say it's like you get to walk up and cut in front of the line. And then also, please subscribe to our weekly economic newsletter. It's called the 5-Minute Market Brief. It's so good. It's informative, succinct. We give you a good idea of what's happening in the market. And by subscribing to it, you can get it right when it first comes out. And we are putting it on our website now, but it takes a couple days to go on there. Also, please subscribe to our YouTube channel, moneyhourradio.com. All right. Well, guess what? We're out of time. God bless you, and we will see you next week.
All right. Take care, everyone.